Hey, what's going on, everybody? Good morning. It is July 21st, 2021. We are live here on Facebook, and we're going to continue on with our Don't Worry, Retire Happy series about retirement planning, obviously. Today, we're looking at step 5, which is how to create enough guaranteed lifetime income to cover all of your living expenses. That includes really two things. Number one is the paycheck, meaning creating enough income to take care of your necessities. But number two, and maybe just as important, is the play check, which is making sure that you have enough income coming in on a regular basis in order to do all of the hobbies and activities that you dreamed of in retirement, so you truly can live the retirement of your dreams. Now, this is going to be a little bit different than last week. Last week, we talked about your investment portfolio and what role having the potential for capital appreciation within your investment portfolio, what role that's going to play in your retirement. But today we're going to shift gears and we're going to talk about sources of guaranteed retirement income. And this is one of my favorite topics to discuss with retirees. And really, this is the key to living a happy, worry-free retirement. This part of the strategy is really the key to putting it all together. Everything that I've discussed over the last few weeks. Today, we're going to show how to mitigate 3 key risks that are involved with investing in the stock market. The risk of withdrawing too much money, the risk of losing principal in a market downturn, and then, of course, the risk, what we talked about, the sequence of returns risk. So we're going to show you how to utilize just a portion of your assets that will generate enough guaranteed income to take those 3 stock market risks off the table and allow you to enjoy your retirement experience. So let's get to it. So there are 3 sources of guaranteed income during retirement. You see at the bottom in the gray are traditional defined benefit pension plans. And if you still have one of these traditional defined benefit pension plans, kudos to you, congratulations, because only about 15% of workers have these anymore, and most of those are government employees. So today we're actually going to talk about a way that you can kind of self-fund your own personal pension. Now, in the orange, you see Social Security, and that really is a type of a pension. And again, a pension is really, it's just a guaranteed income for the rest of your life. Okay, so Social Security, very, very important. But on the left, in the green, this is where we're going to talk about funding your own personal pension, and that is an annuity. And remember, an annuity is a personal pension-like stream of income that you can buy or purchase from a financial institution or an insurance company. Now, you may have heard some objections to utilizing annuities in your retirement plan. You may have heard, well, Dave Ramsey, he says to never buy an annuity. And Ken Fisher, in fact, he takes out full page ads in the newspaper that says, I hate annuities. Well, why is it that you think that they do that? Is it possible that they're competing over your limited dollars, and so they sell a different product and that annuities are competition? And that answer is yes. Again, all an annuity is, you have to remember, it's just a paycheck for the rest of your life. So I want you to imagine something here, because again, Social Security is a form of an annuity. So when you reach your full Social Security retirement age, for some of you that may be age 66, for others that may be age 67, depending on when you were born. But when you file for Social Security and the government sends you that first Social Security check, I want you to imagine that you receive that check in the mail and then you frown. And then you decide, you know what? I'm going to send this check back. And then if they send you another check the next month, because, you know, that's how Social Security works, I want you to take that check and I want you to send it back. And if they persist on sending you a paycheck every single month, you know what I want you to do? I want you to pick up the phone. I want you to call the Social Security Administration, and I want you to say this: hey, you keep sending me these Social Security checks. Social Security is a form of annuity. Dave Ramsey hates annuities and I do too. So quit sending me these checks and take me off your list. Now, is anybody who's receiving Social Security, are they really going to do that? No. Is anybody who is actually lucky enough to still have a defined benefit pension plan and they're receiving paychecks every month, are they actually going to do that? No. Retirees love to have that guaranteed income rolling in every single month, regardless of how long they live and regardless what happens with the economy or with the stock market. You see, so guys like Dave Ramsey and Ken Fisher, what they do is they lie and they tell half truths in order to attack another financial product that competes with what they're trying to sell you. The truth of the matter is that there are no good financial products and there are no bad financial products. Every financial product is simply a tool that is designed to help you meet an end goal. And you'll see that the Don't Worry, Retire Happy program is all encompassing and it's very comprehensive. It utilizes everything. It utilizes annuities. It utilizes investments. It utilizes insurance. And it even talks about things that doesn't compensate your financial professional at all, like educating you on the best time to take Social Security, educating you on how to mitigate long-term care risks, and educating you on how to use your home equity wisely. So again, this is a comprehensive program. This is about education and then taking the educational principles and applying it to your specific situation and not trying to attack or just sell you something. So annuities can really be a phenomenal tool to bolster your guaranteed income sources in retirement, especially if you do not have a pension, or especially if maybe only one spouse worked, or if your Social Security benefits are low. Now, what does the media say about lifetime income annuities? And I don't mean Dave Ramsey. I mean the non-biased media. What do they have to say about lifetime income annuities? Well, let's start here. Let's start with the U.S. Government Accountability Office. Bullet point number 1, Social Security is not enough. So that moves us to bullet point number 2. The Government Accountability Office says that seniors should convert a portion of their savings into an income annuity to cover necessary expenses. And then bullet point number 3, they recommend that individuals delay Social Security benefits until reaching full retirement age, and in some cases, continuing to work and save if possible. Now, let's look at Reuters because they make really good points here. Most economists actually love annuities, and they have long argued that there is a perfect financial product for retirement income, and that is the humble, immediate income annuity. Pro-annuity economists or proponents, they argue that income annuities protect not only against longevity risk, again, because a true income annuity, it continues to pay you regardless of how long you live. So it does protect you against longevity risk, but also the risk of underspending in retirement. In earlier videos, we talked about the concept of people not wanting to spend their money just in case something bad happens, just in case the market crashes, just in case they live into their 90s. And what they end up doing is they end up not spending their money and living a just in case retirement. But annuities don't work that way because annuities are perfect tools designed to just kick off cash flow each and every month, consistently, reliably, no matter what happens with the economy, no matter what happens in the markets, and no matter how long that you live. So the key behind the annuity is when that paycheck hits your bank account, you know what I want you to do? I want you to go out and spend it. You know why? Because next month that paycheck is going to arrive again. So I want you to run out and spend it. And I want you to enjoy this money. And the month after that, it's going to come again. And the month after that, and the month after that, and the month after that. And again, the key is this is money you can rely on no matter what happens with the economy or the markets, or no matter how long you live. You're able to spend that money because it's consistent, reliable, and it's guaranteed. How about the studies on annuities and retirement happiness? Towers Watson did a whole white paper on annuities and retirement happiness. And guess what? You can download it for free. And you know what they say? They say that people with annuitized incomes are the happiest. Exactly what I was just talking about. Why? Because it provides the biggest satisfaction to boost the lifestyle of retirees. How about the Wall Street Journal? They actually published an article not too long ago that the secret to a happier retirement, people surrounded with their friends, people surrounded with good neighbors, and people who had annuitized incomes. Again, it's just because the reliable income coming in, it's just less stress. You're able to enjoy your retirement because there's more certainty. You know what to expect. And actually, that Wall Street Journal article also talks a little bit about people who have annuitized incomes actually live longer lives. Now, there's probably a little bit more than that goes into it than just this simplistic conclusion that I'm about to draw, but it's got to be part of it. You got to think that people who have annuitized incomes that have that money consistently coming in, again, there's more certainty, there's less stress, and we all know that stress is a huge impact on one's health. So that's got to de-stress their or lower their stress levels. That's got to play a role in having a longer life. The Wall Street Journal also published this article right here about the University of Pennsylvania's Wharton Financial Institute. They found that these income annuities can assure retirees of an income stream for life that is much more efficient than the traditional stock, bond, and cash mix. And again, if you're able to see my screen there, the writing's kind of small, but they say that it's 40% more efficient than drawing money out of your investment portfolio. How about this recent white paper from the Financial Research Corporation? They say the following, that income annuities offer features that others can't. High cash flow, it's uncorrelated to market returns, retirement alpha in the form of mortality credits, which only an insurance company can manufacture, longevity hedging, liquidity features, and their analysis shows that no other investment vehicle can rival the income annuity for retirement security. And there is no other vehicle in the marketplace that can convert assets into income as efficiently as the income annuity. Now, remember that lifetime income, these lifetime income payouts, they consist of three major things. They consist of your return of principal, they consist of investment growth, but here's the secret sauce, because annuities include what's called longevity credits. Only an insurance company in the form of an annuity can manufacture these longevity credits. In essence, it's what insurance companies do. It's risk pooling. Insurance companies subsidize those who die late with the capital of those who die early. And thus, they're able to manufacture much, much higher income payouts. Here's why you use annuities for your distribution strategy. Again, not for accumulation necessarily, but for your distribution strategy, your cash flow strategy. These were the payout rates from almost any life insurance company in America. And I want you to be aware that rates can and do change. In fact, interest rates have lowered a little bit since this has been published, but it's still pretty close here. Now, I want you to be aware, these are not interest rates. These are payout rates. They're distribution rates. You see that at age 65-year-old, a life-only annuity will pay out about 6% or a little bit over 6%. So what does that actually mean? That means for every $100,000 that they place into an income annuity, they can receive about $6,600 of reliable, consistent income per year without any market risk, regardless of what happens in the economy, that will come every year for as long as they live. Now, if you remember from a previous segment, we talked about the safe withdrawal rate from a managed money portfolio. Because the stock market, it goes up and down. The safe withdrawal rate is only between 3 to 4% per year. And that's because of market risk and the sequence of returns risk. So how do these income annuities, how do these payouts compare to the safe withdrawal rate of just 3 to 4%? Well, the income efficiency of the annuity is about twice as much. So here's an important concept to understand. A lifetime income annuity has higher payout rates based on age, because the annuity holder gets paid mortality credits. Again, mortality credits, in effect, the main reason that someone wants to buy a lifetime income annuity is because they get paid these mortality credits. CDs do not pay mortality credits. Bonds don't pay mortality credits. Stocks have never paid a mortality credit in the entire history of the stock market. Now, I'm not saying that those products are bad. In fact, no, they're good, but they have their purpose. But their purpose is not to generate consistent, guaranteed, or lifetime income. You see, lifetime income annuities are structured to satisfy the needs of aging clients in retirement. And that's why annuities are the only financial product that offers these mortality credits. In fact, Dr. Moshe Milevsky refers to these mortality credits as longevity credits because people actually get paid more for living longer. So, now that you're starting to learn the strategy and the concept behind implementing an income annuity into your portfolio, you may be wondering, well, exactly how much of my money should I put into an annuity? Well, this is going to depend on the individual situation, and there's no exact cookie cutter formula, but it really comes down to two main questions. Number one, what do I need my income to do? Again, that's to pay my bills and sustain my standard of living. That's the paycheck. And then what do I want my income to do? All of the fun recreational activities. And that's the play check. So once you've identified those two things, what do I need my income to do? What do I want my income to do? It's really quite simple. We put enough money into an income annuity, we buy enough guaranteed lifetime income, and then we invest the rest. We keep the rest of our money in our investment portfolio. And so next week, what we're going to do is we are going to look at a case study, bringing this all together, implementing your pension, implementing your Social Security, filling any gap with a lifetime income annuity, and then showing what portion of your investment portfolio should then be invested in the markets to offset the effects of inflation. So thanks for hanging in there with me here today. I know this one was a little bit lengthy. We're almost at 20 minutes, but I hope this educational principle really helped to compartmentalize for you or help you to think in your head just different buckets, really. Like we have one bucket of money to provide our guaranteed lifetime income in retirement. And then we have a separate bucket of money that's our investment portfolio that's earmarked toward capital appreciation in order to offset the effects of inflation. And again, next week, we're going to take a look at putting that all together. We'll do a case study to kind of show you how those puzzle pieces fit. But for now, that's we're going to wrap up. That's all we have time for here today. So as always, that's my rant, and thanks for listening.